Folks, let's have a real, honest talk. No sugarcoating, no jargon-filled sales pitches. Just you, me, and a frank discussion about one of the most powerful and potentially perilous subjects in the world of business. We're going to discuss something that can either build your business or bury it. We're talking about debt. Now, that word, debt, it can make even the most seasoned entrepreneur's stomach clench. It can conjure images of sleepless nights, mounting pressure, and a loss of control. For many, it's a four-letter word associated with financial stress and personal hardship, and in many cases, they're right to feel that way. You know my philosophy, and it hasn't changed. I am not a fan of debt. For your personal life, debt is dumb and cash is king. Living on less than you make, saving for what you want, and avoiding interest payments is the surest path to building personal wealth and achieving financial peace. That principle is rock solid. But in the world of business, the conversation gets a little more nuanced. We have to acknowledge that sometimes a strategic, calculated injection of capital can be the very thing that takes a solid business to the next level. It can be the bridge from surviving to thriving. This isn't about borrowing to cover up mistakes or fund a lifestyle. This is about using other people's money for a short period of time to create more money. It's about leverage. Let's be crystal clear on this point. A business loan is not a magic wand. It is not a lifeline for a sinking ship. If your business model is fundamentally broken, if you don't have a steady stream of customers, or if your expenses consistently outpace your revenue, a loan will only accelerate your demise. It's like pouring gasoline on a fire. It won't fix the underlying problems. It will only magnify them, adding the heavy burden of repayment on top of your existing struggles. The best way to think about a business loan is to see it as a tool. Nothing more, nothing less. It's like a hammer, a saw, or a power drill. In the hands of a skilled carpenter with a clear blueprint, these tools can build a beautiful, sturdy house. They can create value, structure, and something that lasts. But in the hands of someone who doesn't know how to use them, who doesn't have a plan, that same hammer can smash fingers, and that saw can cause irreparable damage. The tool itself isn't inherently good or bad. Its impact is determined entirely by the skill and intention of the person wielding it. Used wisely, with a clear plan for return on investment, a loan helps you make strategic moves that generate more revenue than the cost of the debt itself. It helps you buy that new, more efficient oven that doubles your bakery's output. It allows you to purchase the heavy-duty landscaping equipment needed to take on larger, more profitable commercial contracts. It gives you the capital to expand your retail space to accommodate more customers, or hire that key salesperson who can bring in a whole new book of business. These are offensive moves, investments in growth, not defensive patches for leaks. But used poorly, without a clear path to profitability, that same loan becomes a crushing weight. It's the monthly payment that eats into your already thin profit margins. It's the covenant you accidentally violate that puts your entire operation at risk. It's the source of constant anxiety that keeps you staring at the ceiling at 3 a.m., wondering how you're going to make payroll the loan payment. It transforms you from a business owner into an employee of the bank, working tirelessly just to service your debt. So, our mission here is not to teach you how to just get a loan. Frankly, in today's market, getting kind of loan, especially the wrong kind, can be dangerously easy. Our goal is far more important. It's to empower you with the knowledge to become the master of this tool, not its servant. It's to help you understand the different types of loans available, from traditional term loans to lines of credit and SBA-backed options. It's to show you how to honestly assess your business's needs and determine if debt is even the right answer in the first place. We'll walk through how to prepare your financials, how to calculate the true cost of borrowing, and how to spot the predatory lenders and dangerous loan products that can trap you in a cycle of debt. By the end of our time together, you won't just be a borrower, you'll be a strategic financial operator. You'll have a clear, simple roadmap to follow, ensuring that if you do decide to take on debt, you do it with your eyes wide open, from a position of strength, and with a solid plan to come out the other side more profitable and in complete control. This is about building your business on your terms. Let's get to work. Before you walk into a bank, or more likely, before you click that tempting Apply Now button on a lender's website, I want you to do something radical. Stop, just for a moment, take a deep breath. Taking on debt for your business is one of the most significant financial decisions you'll ever make. It's not a quick fix or free money. It's a strategic tool that, if used correctly, can propel you forward. But if mishandled, it can become an anchor that drags your business down. The difference between success and failure often comes down to the preparation you do right now, in this very moment of pause. So, sit down. Not with the application form, but with a simple pen and paper, or a fresh spreadsheet. We need to get absolutely, undeniably crystal clear on the fundamental question: why specifically do you need this loan? And I need to be blunt here. I need money to grow is not an answer. That's a wish. It's a hope. And while hope is essential for any entrepreneur, it's not something a lender can underwrite. Lenders don't fund wishes. They fund well-articulated, data-backed plans. They are in the business of managing risk, and a vague goal is the biggest risk of all. Your job is to transform that wish into a concrete, investable plan. The first step is to state your need in one single, powerful sentence that covers three critical elements: what you need, why you need it, and the expected outcome. Let's use a real-world example. Imagine you run a small, successful bakery. You're selling out of your artisanal bread every day by noon. Your wish is, I need money to grow. Your plan sounds like this. I need $15,000 to purchase a new commercial-grade deck oven, which will allow me to increase my daily bread production by 40% to meet existing customer demand. See the difference? It's specific, measurable, and directly tied to revenue. Now let's break down that $15,000. You cannot pull a number from thin air. Every single dollar must be justified. Get official quotes. For our baker, the breakdown might look like this. The oven itself costs $12,000, according to a quote from a restaurant supply company. The specialized electrical installation is quoted at $2,000. And you wisely budget an extra $1,000 for the initial increase in flour, yeast, and other raw materials to support the first few weeks of expanded production. That is how you arrive at a defensible loan amount of $15,000. Every extra dollar you borrow is a dollar you have to repay, with interest. Overborrowing is a common and costly mistake. Be precise. Next, you must calculate the return on this investment. How will this oven pay for itself and generate a profit? Let's do the math. The new oven allows you to bake 80 extra loaves per day. You sell each loaf for a net profit of $2. That's an additional $160 in profit each day. If your bakery is open 6 days a week, that's $960 in extra profit per week, or roughly $4,160 per month. Now you can clearly see how you'll make the loan payments and still increase your take-home profit. You can also calculate the payback period. The $15,000 investment, divided by the monthly extra profit of $4,160, means the oven will have paid for itself in under 4 months. This is the language lenders understand. Let's take another example. A landscaping business. The owner's wish is, I need money to expand my service area. Again, that's too vague. A fundable plan sounds like this. I need $35,000 to purchase a commercial zero-turn mower and a larger enclosed trailer, which will allow my crew to service 3 additional large-scale commercial properties per week, increasing monthly revenue by an estimated $9,000. Let's justify that $35,000. The commercial zero-turn mower, based on a quote from a local dealer, is $25,000. A new, larger enclosed trailer to transport it securely is $8,000. The owner adds $2,000 for vehicle registration, insurance adjustments, and branding for the new trailer. The total is a well-documented $35,000. No guesswork. Now for the return. The new mower is faster and more efficient, allowing the crew to take on 3 new large commercial contracts, each worth $3,000 per month. That's a $9,000 increase in monthly top-line revenue. After accounting for fuel, maintenance, and labor costs, let's say those are $3,000. The net profit increase is $6,000 per month. With a $35,000 loan, the payback period is just under 6 months. The business owner can now walk into a meeting with a lender and present a clear, compelling business case, not just a request for cash. These are the exact questions any good lender will ask you during the underwriting process. What is the specific use of funds? How did you arrive at that number? What is the projected increase in revenue? What is the net profit on that revenue? What is your payback period? The secret is to ask and answer these questions yourself first. Define the need with precision. Calculate the exact cost with evidence. Project the financial return with conservative math. If you get this right, you're not just ready to apply for a loan. You've already proven you have the business acumen to manage it wisely, placing you far ahead of half the other applicants before you even fill out a single form. Once you know how much and why, it's time to look at the menu. There isn't just one type of business loan, many flavors for different needs. Term loan, a lump sum repaid monthly, often over 3, 5, or 10 years. Best rates, strictest requirements, strong history, and great credit. SBA loans. The government guarantees a portion, reducing lender risk. Lower rates, longer terms, more paperwork, slower timeline. Online lenders. Fast applications and funding, but speed costs more. Some products aren't loans and carry sky-high costs. Read every line. Business line of credit. Approved limit, draw as needed. Pay interest only on what you use. Great for cash flow. Equipment loan, designed for machinery or vehicles. The equipment is collateral. Invoice financing, advance on unpaid invoices. Cash now instead of waiting. Match the right tool to the job. You've successfully identified your business's need and have surveyed the landscape of available financing options. That was the strategic part. Now we move to the tactical phase, getting your financial house in pristine order. This isn't just about tidying up paperwork, it's about building an undeniable case for your business's creditworthiness. Think of yourself as a lawyer preparing for a high-stakes trial. The lender is the judge, and your preparation will determine the verdict. A well-prepared application doesn't just get approved, it gets better terms, lower rates, and a smoother process. This phase is your opportunity to control the narrative and present your business in the best possible light. Let's break down exactly how to do that, step by step. First, let's talk about credit. And yes, for most small or new businesses, we are starting with your personal credit. Lenders see you and your business as one and the same, especially in the early stages. Your personal credit history is their primary gauge of your financial responsibility and reliability. It's your character reference and your reliability scorecard, all rolled into one number. A strong personal credit score tells a lender that you manage debt responsibly, which gives them confidence you'll do the same with their loan. A weak score, conversely, is a major red flag that can stop an application in its tracks, regardless of how brilliant your business idea is. So, our first mission is to know your score and take concrete steps to improve it. Your immediate 30-day action plan starts now. First, get your free annual credit reports from all 3 major bureaus, Equifax, Experian, and TransUnion, via the official government-mandated site, annualcreditreport.com. Once you have them, don't just glance at the score. Review every single line item. Look for inaccuracies, misspelled names, wrong addresses, accounts you don't recognize, or late payments you know were made on time. Even small errors can drag your score down. If you find a mistake, dispute it immediately, both with the credit bureau and the creditor that reported the information. The Fair Credit Reporting Act gives you this right, and cleaning up errors is the fastest way to see a potential score increase. Next, focus on your 60-day improvement plan. The 2 most significant factors in your score are payment history and credit utilization. To tackle payment history, set up automatic payments for every single bill. Even one 30-day late payment can devastate your score. For credit utilization, that's the amount of revolving credit you're using compared to your total limits. Aim to get all credit card balances below 30% of their limit. If you have a card with a $10,000 limit, try to keep the balance under $3,000. If you have the cash, paying down high-interest, high-utilization cards is a powerful move. Over the next 90 days, make this a habit. Consistent on-time payments and low balances will steadily build your score, demonstrating the financial discipline lenders want to see. With your credit improvement plan in motion, it's time to articulate your vision. You need a business plan. This doesn't have to be a 50-page novel, but it must be a clear, concise, and compelling document, typically 1 to 3 pages for a simple loan request. This plan answers the fundamental questions. What does your business do? Who are your customers? How do you make money? And most importantly, how will this specific loan make your business more profitable? A weak plan might say, I need $25,000 for marketing. A strong plan says, I am requesting $25,000 to fund a targeted digital advertising campaign on Facebook and Google aimed at women aged 25-45 in my metropolitan area. Based on pilot campaign data, we project this will generate 500 new leads, converting to 100 new clients and $75,000 in new revenue over the next 12 months. See the difference? Specificity inspires confidence. Your plan must include basic financial projections. This is where you connect the loan directly to your bottom line. Create a simple table showing your key metrics, like revenue, cost of goods sold, and net profit, as they are now, versus how you project them to be in 6, 12, and 24 months after the loan is put to work. This demonstrates that you've done the math and aren't just guessing. It shows the lender their capital will be used to generate a return, ensuring you can comfortably make repayments. This isn't about promising the impossible. It's about showing a realistic, well-reasoned path to growth. Now let's assemble your document package. Waiting until a lender asks for these items creates delays and makes you look disorganized. Gather them now. Create a dedicated digital folder and, if needed, a physical one. You'll need government-issued photo IDs for all owners with more than a 20% stake. You'll need your business formation documents, like your Articles of Incorporation or LLC operating agreement, and your business license and permits. Having these ready to go shows you're serious and efficient. The most critical financial documents are your bank statements and tax returns. Lenders will want to see your cash flow firsthand. Gather 6 to 12 months of both your business and personal bank statements. They'll also require your last 2 to 3 years of filed business and personal tax returns. If you use an accountant, ask them for a complete package of these documents now. If you manage your own, download the PDFs from your online banking portal and tax software. Organize them into clearly labeled subfolders by year and document type. This level of organization signals professionalism to an underwriter before they even read a single number. This brings us to a non-negotiable rule. You must separate your business and personal finances. If you haven't already, go to a bank and open a dedicated business checking account today. All business income should go into this account, and all business expenses should be paid from it. Using your personal account for business transactions, known as commingling funds, is one of the biggest red flags for lenders. It makes it impossible for them to analyze your business's true financial health, and it suggests a lack of professionalism. It implies you're running a hobby, not a business. This single step is foundational to being seen as a legitimate, fundable enterprise. By taking these preparatory steps, improving your credit, writing a clear plan, and organizing your documents, you create a clean, unambiguous paper trail. This trail tells a story of a well-managed, disciplined, and serious business owner. It allows an underwriter to quickly and easily verify your revenue, assess your cash flow, and understand your vision. This preparation doesn't just get you a yes, it dramatically boosts your approval odds, accelerates the funding timeline, and positions you to secure the best possible terms for the capital you need to grow. You've prepped. Now, apply smartly. Don't take the first offer. Apply with 3 to 5 lenders, local bank, credit union, and reputable online options. Be honest and thorough. Underwriters find discrepancies. Explain weaknesses up front. Lenders look for the 5 C's: character, capacity, capital, collateral, conditions. Tell a strong story for each. Expect follow-up questions. Respond promptly, clearly, professionally. Compare the whole package: rate, term, fees, prepayment penalties, collateral. A lower rate with high fees can cost more. Ask for APR, interest plus fees. Lay offers side by side and pick the best for your bottom line. You're selling your business and yourself. A loan agreement is binding. Do not skim and sign. Read every word. Ask until you fully understand. Check the interest rate, but compare using APR, the true annual cost including fees. Identify all fees, know amounts and when they're charged, including late fees. Be wary of prepayment penalties. You should be free to pay early. Understand repayment schedules. Daily withdrawals can crush cash flow. No timing and amounts. Longer term, chaos, lower monthly, more total interest. Shorter term, higher monthly, faster payoff. No collateral requirements. Equipment, receivables, inventory, even your home. If you won't risk losing it, don't sign. Period. Improve odds before you apply. Keep business accounts healthy and balances consistent. Keep personal and business finances squeaky clean and separate. With strong apps and multiple offers, negotiate rates, origination fees, and prepayment penalties. Be respectful and professional. Asking can save thousands. After funding, use the money exactly as planned. Keep meticulous records. Save every receipt and invoice. Build a track record. You loaned me $20,000. I grew revenue 30%. That's gold. Pay on time every time. Set autopay. If trouble looms, call your lender early. Good lenders prefer solutions over collections. Predatory offers exist. You must spot red flags and walk away. If it seems too easy, be skeptical. Legit lenders verify ability to repay. Payday-like loans and MCAs can hit triple-digit APRs and cripple a business. Don't borrow more than you need. Extra dollars come with interest and monthly payments. Avoid debt creep. Read the fine print. Hidden fees, confusing terms, clauses giving lenders too much power. Walk away if rushed. If unprofitable or cash flow is erratic, debt fuels the fire. Consider savings, grants, partners, or bootstrapping until stable. One step at a time. Here's your action plan. Start today. Define your need. Put a specific number next to it. Research and get quotes. Pull your personal credit report. Understand it. Write a one-page plan. Organize bank statements, tax returns, IDs. Apply to multiple lenders. Compare APR, fees, terms. Read the entire contract. If you proceed, manage the loan with discipline. You're the CEO. You can do this. It's time to get to work.